In this video clip, I look at the first step in the NCI calculation for one of the tutorial questions, questions 1811. Now, in the previous video on pre-acquisition equity entries, I've made the comment that for the parent company, their share of the equity, we have to determine whether their share in the equity relates to equity that existed on acquisition date, so pre-acquisition equity, or whether the changes that are made to the equity relates to post-acquisition equity. With the NCI calculation, we don't split their share of the equity into pre and post-acquisition. We do it in a three-step process by first of all calculating their share of the equity on acquisition date. Secondly, we then cover the period since acquisition until the beginning of the current financial year. So any changes in equity from acquisition date till the beginning of the current period, we'll calculate their share of those changes. And then lastly, we look at the current financial year to calculate their share of change in the equity in the current period. So in this video clip, we're just going to look at step 1. We calculate their share of the equity that was recorded at acquisition date. Now remember, it's their share in the subsidiaries' equity, even though they're seen as a capital contributor to the group. So part of the subsidiaries' equity on acquisition date is the BCVR that is created. So they, as a capital contributor to the group, have to share in the BCVR reserve as well. The calculation that we do in step 1 will be passed in all subsequent consolidation worksheets and will never be changed with as a result of transactions or journal entries that affect pre-acquisition equity. Because for NCI calculation, we deal with the journal entry in the period which it relates to. So let's look at that first calculation. Now in the question we were told that the share capital of the subsidiary on acquisition date was $20,000 and the NCI's amount to 25% of the share capital. So a quarter of the 20 is attributed to the NCIs. Retained earnings on acquisition date was $10,000. So if we divide that by 4 or times it by 25%, gives us their share in the retained earnings. Then the general reserve of $2,000. They are entitled to $500 of that. The BCVR has been calculated, and 25% of that is $2,100. Now, because we don't record their investment in the subsidiary in our accounting records, we can't eliminate it, or we don't want to eliminate it against their investment. What we want to do is we want to extract, and that's the big difference between how we deal with the parent share in the equity versus the NCI. We want to extract their share in each of the individual equity balances and group it into a one-liner which forms part of the equity of the group, but it's disclosed separately. So any reader of the financial statements can then clearly see which portion of the equity has been attributed to the NCIs. So this then forms our starting point for what the NCIs are entitled to. Hereafter, we then have to just see, with regards to the subsidiaries' equity, and of course at later years there can new reserves and equity balances can be included in the list. So what we have to do is we then have to see for all the changes that happens in these equity balances, what of that needs to be extracted and allocated to the NCIs. So from this date onwards, we're just concerned about the changes in the equity balances and then the NCI will what is allocated to them on the NCI line item will move in line with those changes in the equity balances. In the next video clip, we'll then look at step 2, covering the period since acquisition date until the beginning of the current financial year.